Hi, everybody. Thank you for joining today. Our presentation will be on United States sales and use tax, a look back into 2017 and a look forward into 2018. And not to telegraph the whole presentation, but this is a ridiculously exciting time for those of us working in the area of sales and use tax compliance. Not that the preceding 10, 15 years weren't interesting as well, but I think we've really seen an uptick in the level of excitement, interest, and challenges associated with maintaining sales and use tax compliance. For those of you who don't know me, my name is Chuck Maniace. I'm the Director of Regulatory Analysis here at Sovos. I'm your host and moderator today. By way of background, I've been with Sovos for some 15 years now, and in my experience has largely been in the area of sales and use tax. So that's the regulatory regime where I personally grew up. I'm very excited today to have two co-presenters, Metisse and Kelly from Grant Thornton. And as soon as I can advance the slide, there we are. Metisse and Kelly, could you introduce yourselves?
Thanks, Chuck. Hi, everyone. My name is Metisse Lutz. I'm an experienced manager in our indirect state and local tax group out of the Denver office. And I've been with Grant Thornton about 4 years. Before that, I was with Big Four, public accounting, and prior to that, large corporate law. So very excited to be here. Like Chuck said, there's some really great and exciting things happening, and we're excited to share it with you.
Kelly, could you introduce yourself? Kelly, you might be on mute.
Hi, sorry. I'm Kelly Gebhart. I'm a manager in the state and local tax department in the Dallas office. I've been in sales tax for 15 years. I joined Grant Thornton in 2016, and before that I came out of industry, really focused on the manufacturing environment.
Excellent. And thank you both so much for presenting with me. I really think, here at Sovos, and we'll talk a little bit about what Sovos does and a little bit about what both of our organizations do, but one of the great things is having two different perspectives. So I come from the solutions perspective to compliance needs, and you come both from the consultancy perspective. And I think having both on a single webinar really creates a value add for our clients and the attendees. And attendees, please let us know at the end of this presentation what you thought about this sort of format. But I think it's really preferable to any one person talking alone. So here's the agenda. We're going to talk a little bit about the new reality in tax compliance. If you're living it, you're probably aware of it, and hopefully your head will be nodding in the affirmative as we go through that stuff. We'll spend a decent amount of time talking about Nexus, because Nexus, of course, is where all the exciting developments are happening, both at the state and the federal level. We'll talk a little bit about the changes in the world of how tax applies to SOTA, and how SOTA is sort of almost a microcosm of what's happening in the world of tax in general in terms of new rules and challenges with relate to compliance with those rules. And then we'll take, and this is always a little bit dangerous, but we'll take we'll gaze into the crystal ball, and we'll sort of make some predictions as to what might happen in 2018. So a little bit about Sovos. A little bit about Sovos. So Sovos was founded back in 1979. I'm sitting right now in our headquarters in a suburb of Boston. Contrary to understandings across the organization, I was not here when the company started. I've only been here 15 years. As an organization, our solutions are utilized by more than half of the Fortune 500 companies. We're a global entity, and we have almost 4,500 clients operating most everywhere around the globe. We have offices around the globe, including London, Amsterdam, and multiple offices in South America, including an office here in Wilmington and Denver, and in Minnetonka, Minnesota. Really a global entity. We are a global leader in tax compliance and business to government solutions. And included in that, but it's not limited to that, is sales tax, which we'll be talking about today. So,
and Grant Thornton is, yeah, thanks, Chuck. So Grant Thornton is also a global firm here. We have a large presence here in the U.S. with 58 offices, serving clients in every industry you can imagine, in the tax, audit, and advisory service lines. And then we have a global footprint expanding overseas with over 733 global member firms that we all work with on a regular basis. I know I can personally speak to the fact that in the past year or so, we've taken global indirect taxes stateside, in a sense that we've provided our clients with a stateside contact, which has been a great way to expedite those global indirect taxes, your VAT, your GSTs, et cetera. But we've been partnering with our member firms across the globe, and we've been able to serve our clients in a great way through doing that.
Great, thank you. So without further ado, let's get into the meat of this presentation. We have a lot of slides to go through, a lot of good stuff. So really, let's start by talking about what we think is driving all the regulatory change that we're seeing across the world of sales tax. And really, it all comes down to this concept of the tax gap. And the tax gap, for those of you who haven't heard the term before, is the difference between all the tax money that could be collected under the current rules, that means without any changes to legislation or regulation, versus what is actually collected. In the US, that tax gap number is estimated at being more than 23.3 billion, meaning there's a lot of transactions escaping taxation. For example, in the US, you could say that all of the e-commerce transactions that aren't taxed based on our existing physical presence standard, but could be collected by use tax obligations, but is not, is part of that gap. The US is not alone. Don't feel lonely. The rest of the world is experiencing a tax gap problem. In the EU, across the 24 member states, that gap is identified as being close to 160 billion. Italy, who's actually doing a whole bunch of things to address this, believes that they can't collect a third of what they should be collecting under their laws. And really, what's interesting, and what we'll talk about in the course of this presentation, is that the US has taken one approach to identifying the tax gap. The rest of the world has actually taken a different approach, and it's a more of a technology-based approach and a more of a real-time information approach. There's some of that in there with what the US is doing, but I think they do stand in stark difference. Obviously, that's probably a topic for another presentation on global approaches to the tax gap, but we will talk a little bit about it here and there. So really it's about technology and how technology has changed the way businesses operate in a way that exacerbates the tax gap, and how governments regulate. So, for example, let's think about manufacturing businesses. Manufacturing businesses now have the technology to not only to sit in their traditional spot in the supply chain in terms of being a supplier to other businesses, but really using technology, using the internet, using all this functionality that's available, they can also go out and sell at retail. It really expands what they can do. I think the saying is that software is eating the world. Almost every company in some way is a software provider, and because of that, there are software-related compliance obligations. And you also hear of this concept of the Internet of Things. And really, the internet is embedded into products and services in a way that hasn't been true before, and it makes all these companies data providers or data solutions. It's really opened up all sorts of avenues for additional revenue. But at the same time, technology is also enabling governments to regulate more aggressively. So what we've seen over the last couple of years is that compliance is getting far more aggressive. So for example, most returns these days are transmitted electronically. And if that return is just a few seconds late, maybe even a microsecond late from the stated due date when it's transmitted, a lot of states, or at least a good number of them, will immediately shoot out a penalty notice indicating that you didn't meet your timely filing obligation. The other thing is the pace and change of audits. If states use technology correctly, and some of them are starting down this path, they can really use big data, analytics, information to really drill down and to make sure a organization is complying. And in fact, we're seeing the beginnings of that here in the US, that technology is enabling a much more comprehensive and much more sophisticated audit approach than what used to be the case, where literally an auditor would come to your office and sit in the conference room for days on end analyzing your data. And the other thing is that regulations become... Go ahead.
Yeah, I was going to say they've also been aggressive. States have been very aggressive on technology as far as they're not accepting paper returns anymore, and that's really hard for some taxpayers because they're just not set up yet for web filing. And even if you file a paper return on time, you will still get that late notice because, like you said, if you don't click that button and submit by that minute, the state sends out that late notice whether or not it's postmarked on time. So they are very aggressive on that.
Exactly what we're seeing as well. I was on a call recently with a client, and they essentially asked the question, do auditors give you a good faith pass? In other words, are you trying, if you're trying your best to be in compliance and you make a few mistakes here and there, do you get a break? And the answer is quickly becoming no. In a lot of circumstances. Is that what you're seeing as well?
Yeah, definitely. Yeah.
No such thing as a good faith best effort.
Well, and I think also auditors, since jurisdictions are going towards this online filing, they see it as an easier way for taxpayers to comply. So that good faith, I try to comply is starting, like you said, to really disappear.
Mm-hmm. Exactly. So let's talk a little bit about what our clients and what the world is telling us, and they've been telling us the same thing. And there's two things that I found in this slide that were really, when I saw them for the first time, shocking. Is that people are saying that in their entire professional lives, they have never seen this kind of pace and rate of change. And of course, this information comes from Grant Thornton. Thank you very much. And it's absolutely true. I've only been here 15 years, and I'm fortunate to have an experienced panel with me today. And I think you would probably echo the same thing. I haven't seen this type of change across the entirety of the globe, including the U.S., ever in my professional life.
Absolutely, yeah. And we're seeing a lot of innovation with AI and all of these tools that are coming out to really change the pace of tax. So yeah, completely agree.
Yep. And what's the most frightening is this idea here at the bottom where 45% of CEOs are saying compliance costs are their number one barrier to growth. I think that's amazing, and that's up sharply. That's, I think, a statistic you've tracked historically, and it's up sharply in the last year or two. And really, when you sit in that role as being you're in finance or you're the head tax professional in an organization, the last thing you want to tell the CFO or the CEO is that we can't do this new thing because if we do it, we can't manage the compliance obligations associated with it.
Yeah, I definitely see clients asking that and saying, do we have to be registered? And if we're going to go in this, if we do this in this state, are we going to have to be registered in that specific state? And they're really looking at it more because it is compliance is a pain.
And really, it's about data. And we'll talk about this in the course of our presentation, how tax authorities here in the U.S. and around the globe are simply getting more information. We'll talk a little bit later about the Colorado notice requirements and how those exist are existing in other jurisdictions and are on the verge of being enforced, and how states are compiling data and then utilizing that data, triangulating with it to increase compliance, to find alternative avenues to obtain tax revenue. So even on the AP side, I mean, when we here in tax, we often have an AR bias, but there's going to be information out there that allows governments to evaluate the tax compliance of purchasers even more aggressively than it does today. And really, it all does bear out in the statistics. So the Aberdeen group commissioned a survey last year, and no matter what industry you're in, whether it be manufacturing, retail, or something else, every single person said that their biggest compliance challenge is increased audit frequency and the costs associated to support an audit. Challenges do remain in terms of the volatility of rate and rule changes. That's still absolutely up there. And when you combine those two things, you have a very, very, very challenging compliance environment. So let's jump in to the world of Nexus. And this is a lot of exciting stuff to talk about here. So I'll only spend a minute getting everybody lined up on the very basics. So today, as we sit here, the state jurisdictions are still compelled to follow the physical presence standard, meaning very, very, very loosely, states can impose an obligation on sellers to collect and remit their sales tax unless they're physically present in that jurisdiction, meaning they have people or they have property in that jurisdiction. And of course, every state defines that a little bit differently, but every state has to have a rule that's ground in that standard. Now, what we've seen over the last couple of years, and we'll talk about how we've seen this this year continue to develop, is that states have been doing everything they can to what I would describe as nimble at the fringes of this doctrine, the Quill Doctrine, which of course derives from the Quill versus North Dakota case from 1992, and find ways that they could apply their tax so that e-commerce transactions from remote sellers don't escape to the extent that they can. And we'll talk a lot in this upcoming slides about notice provisions, and we'll talk a lot about cookie rules, marketplace liability, this idea that marketplace sellers can be put in the shoes of an actual seller or marketplace providers. And since they know everything there is to know about a transaction, and since they're bigger, this idea that they can take on that sales tax liability for their marketplace clients is growing. It's probably worth a webinar on its own, but here today, we'll spend some time talking about notice and cookies. So, by way of a quick highlight of what happened in 2017, we have notice requirements in Alabama, Colorado. We have marketplace rules in Minnesota, Pennsylvania, Rhode Island, and Washington. We have cookie rules, which we'll talk about in Massachusetts and Ohio, and some other stuff happening in New Jersey and Virginia. Maybe my colleagues from Grant Thornton want to talk a little bit about those things. I know we don't spend so much time on them in the rest of the presentation, but I know you had some insight.
Yeah, I think Minnesota really paved the way for this new marketplace rule, which is very interesting in terms of how aggressive they're starting to get. Granted, Minnesota did have a provision in their rule that says it won't go into place until I believe it's 2019, or a ruling from the Supreme Court with respect to Quill. But we're really seeing a lot of states like Rhode Island and Washington, and like you say up here as well, Pennsylvania, really imposing reporting requirements and compliance requirements on those marketplace providers. So, your eBays, your Amazons, et cetera, which are these, large scale internet retailers, if you want to call it that, which is a loose term, right? But they're creating these global footprints. They're putting in large warehouses. There's one right up the street from me here in Denver, So it's very interesting to see how that marketplace provider imposition is going into effect. Other than that, what I think is really interesting on this slide, and I don't think we spend much time on it going through the slides, but Mississippi has a really interesting regulation that imposes a use tax, and they say that it's for sellers who purposefully or systemically exploit the Mississippi market. And it's really interesting. There is a dollar threshold, but the way that they define that is really kind of crazy. And it's anything from your typical advertising in television and radio to email, text, tweets, any kind of messaging to a Mississippi customer. So it's very interesting. It's a new kind of evolution of how we're seeing states go after out-of-state sellers.
And not to telegraph the rest of the presentation, but we could see, should a decision come down that overturns Quill, we could see more of that stuff, more very state-specific approaches to placing that obligation on certain types of sellers that could vary substantially from jurisdiction to jurisdiction.
Absolutely, and yeah, how they define it, right? So yeah, it'll be very interesting.
So, really, I thought one of the most interesting developments of last year was this cookie rule in Massachusetts. And when it came down, it left me wondering, why has no state thought of this before? So, very quick history. First thing that Massachusetts did was they issued a directive, the Department of Revenue. Ultimately, that directive was challenged, and really they challenged it based on the fact that it really should have been done as a rule or a regulation, which Massachusetts then did. So we have a regulation in place that's currently being challenged. And what it did was it articulated a standard which made clear that Massachusetts believed that most technology companies have traditional Quill physical presence nexus. And what they said was that because any company that holds software, and don't forget, software is not sold, it's licensed, in the state, has property in the state, and by having property in the state, you have a collection and remittance requirement. And when they say software, they meant any type of software, including when companies deposit on a person's computer or device these little cookies that then facilitate the user experience as the customer goes back to that website over and over again, hopefully for the customer of the supplier to buy things. And what Massachusetts said was that if you do these things and you have more than $500,000 in sales into Massachusetts, you have an obligation. And it did so in a way that aligns with existing laws. So it didn't necessitate necessarily that the court overturned the Quill decision. And I thought that was really the most interesting thing about it. And personally, I think, and we talk about this a little bit later, how this could influence how the Supreme Court views the current challenge before them. So Metisse, Kelly, any thoughts on that Massachusetts rule?
Well, what I think is really, really interesting, as you touched on, is the fact that they did this by directive at first, because the state blatantly said that they interpreted existing law in a way which complied with Quill. So they didn't think they needed anything that was bright line whatsoever. Now, I just find that shocking, but the way that they put this into place is, like you said, I'm surprised others haven't taken this approach.
Well, yeah, I can see it. So many states in the past have, software used to be kind of an intangible and stuff, and now they say, hey, it's tangible personal property. And so I can see how they're saying, well, now what's software, and defining that and spreading it out over all these things like Massachusetts did. The slippery slope.
It is. And of course, if something looks interesting and successful, other states are soon to follow. So maybe talk a little bit about what Ohio has done.
Yeah, Ohio is really interesting. So they've created this legislation that defines substantial nexus to include sellers that use in-state software to sell or lease taxable tangible personal property or services there is a dollar threshold. I think it's about, $500,000. And they really say that it's where the benefit is received in the state, which is an interesting term to use, right? Because we only really see that in Washington with respect to the B&O tax. But they also point out that a seller that enters into agreements with another person to provide CDNs in Ohio to accelerate or enhance the delivery of a seller's website to consumers will have substantial nexus as well. They also define in-state software to be computer software that's stored on property in Ohio or distributed within Ohio for facilitating seller sales. So it's very interesting how they're really defining this in-state software. And we could see this, extending to a lot of, our client base that wouldn't necessarily have these impositions previously. So, data centers, co-location centers, things of that sort who have this software that's being distributed and used within the state. Very interesting. Another, very odd, but kind of sensical in a sense, use of expanding Nexus, not to agree with the state in any way whatsoever, but still just a very, a new development that I think, like we said before, we're going to start seeing, across the country.
Do you know, is the Ohio rule, is it being challenged currently like the Massachusetts one is?
I don't believe so. I haven't heard anything. I don't know if Kelly, you've heard anything, but no, I haven't heard a single peep out of Ohio.
No, I haven't either.
Neither have I, so it could be that.
Go ahead, Chuck, sorry.
No, go right ahead, please.
No, I was just going to say, Ohio does have some interesting rules with respect to software and software as a service, where they really talk about control and maintenance of control over a license or access to use. So, maybe taxpayers are looking at this and saying, well, it's not hugely different than what we're currently seeing, but in essence, it truly is. So I don't know. I really haven't seen anything.
So really, it's really interesting. So let's talk a little bit about this Colorado notice requirement. This happened last year in terms of the rule. Actually, it's been percolating for years, but the rule became official last year, and it's become ripe this year. So maybe Kelly Metisse, you want to talk a little bit about Colorado?
Yeah, so this all came out of the DMA case, which I'm sure a lot of folks are really well aware of, starting back in, I think it was all the way back in 2010. Finally got settled out last year, like you said, Chuck, where the state settled out any penalties and interest and all that accrued over the period of the up and down rulings from state to federal level and back down. And basically what this said was, out-of-state retailers who have no nexus in the state of Colorado must now provide these notices to their customers and to the state with respect to sales made within the state. So there is essentially 3 notices that are required to be done. The first one is a transactional notice, which is on the face of an invoice that must say, we are an unregistered out-of-state seller, you must remit use tax on this purchase. Then there's an annual notification to Colorado purchasers, which shows the purchases made over the course of the year with that out-of-state seller and quantifies them for that purchaser in state and says, you've made these purchases, we haven't charged you a sales tax, you have an obligation to remit the consumer's use tax to the state. And then finally, there's an annual statement that each purchaser must file with the department, which is in the form of, that consumer use tax. It's interesting. There are very high penalties for noncompliance on the seller, the out-of-state seller, as much as I believe $5 to $10 per transactional notice that does not have that verbiage on there. So it's a little steep and it's a little scary. But the state implemented it back in, I want to say July, and, January 31st, I believe, is when the annual notification was due to purchasers, and then the annual statement is due, I think, in March. So it's live, it's active, it's happening, and it's a big change.
And I think it's important to look at because, you know, in some companies you have to really do a lot of changes technology-wise to get those statements on your invoices and to keep track of all that, make sure those annual notifications go out, make sure those annual statements go out. And if you have a tax system in place, it might be just as easy to click the button and say, let's start collecting tax in Colorado, which is probably what Colorado would really like you to do anyway. So I think it's definitely a question of, well, which is easier for our company to do, and which is the most likely that we won't have have compliance issues. We won't get penalties for non-compliance. Is it easier to just start collecting and remitting the tax, or change all these invoices and notifications and statements?
Yeah, no. And so it's interesting. Sovos has a lot of clients in the winery space that sell direct to consumer from, let's say, California wineries to Colorado customers. And absolutely a lot of them made the choice to simply register and collect and remit rather than comply with these requirements.
I mean, it's a huge burden, right? We saw a lot of our clients panicking in a sense to say, you know, how am I going to comply with this? You know, my ERP system, in order to make these changes, it's going to cost me in the millions. How am I going to do this? And it was really interesting. I actually sat on the state task force in editing and revising the regulation that came out. And a lot of the debate was about that transactional notice and how many characters you could get on the face of an invoice and all of that. And, you know, there was a lot of debate that the state just didn't understand with respect to our clients and, you know, how onerous this is, but they still went forward and did it.
And of course, a good idea never goes unnoticed. So certainly other states have followed along, huh?
Of course. We're seeing it kind of widespread these days. I think of note, Vermont was one of the first after Colorado in their own, rule. They stated something to the effect of it will take place at X date, which I can't remember, or the ruling for the state in DMA. So they specifically cited the Colorado. But we're seeing this kind of widespread. Tennessee put something in place, but I believe that's currently on hold through litigation. South Dakota, as we know, has some interesting stuff going on currently, which we'll touch on, or I guess we touched on already. And then, other states, Kentucky, Louisiana, Oklahoma, and I wouldn't be surprised if we see many, many more. Rhode Island and Washington, as we touched on before, with respect to the marketplace requirements, they do have a complementary, maybe we should call it, reporting requirement similar as well.
Indeed. So, and it'll be interesting to see how these continue to develop given what's happening with this federal case. And so let's spend a few minutes on this. I'm sure everybody in the audience wants to hear a little bit about the Wayfarer case and what it means. So, over the last decade plus, there has been this movement to, in some way, reconsider, reevaluate the Quill decision. And even the Quill court said that Congress, for example, could decide to do something else. They could use their positive Commerce Clause authority, to get lawyerly for a second, and essentially say that it's not a burden on commerce to require collection of tax from remote transactions, businesses without physical presence. But over the course of the last 2 decades, Congress really hasn't been able to act in that way. Bills have been introduced, the Marketplace Fairness Act, the Remote Transaction Parity Act, the proposal by Representative Goodlatte, which would have turned sales tax compliance on its ear. None of it really went anywhere. The MFA passed the Senate, never passed the House, but really not much of activity. Back in 2015, back to that DMA versus Broll case that we talked about earlier, in a separate concurring opinion, meaning it didn't really speak to the heart of the matter of the case, Justice Kennedy, who was in the majority on the Quill case, said, you know what, the time may be right for us to reconsider the Quill decision. States, if you were so inclined and you wanted to pass a rule that would challenge it, bring it on. And of course, immediately, several states opted to bring it on, including but not limited to South Dakota. Alabama did it and a couple of others as well. So essentially, those cases over the last couple of years have been making their way through the court system. South Dakota kind of becoming ripe the earliest. And just a few weeks back, the United States Supreme Court announced their willingness to hear the South Dakota case that would essentially seek to overturn Quill. So South Dakota passed a rule that essentially said Nexus exists based not on your physical presence, but your economic presence. How much you sell to South Dakota customers, how many transactions you engage involving South Dakota customers. And the case was challenged. South Dakota said, we know you're going to challenge it. We're going to issue these assessments. Go ahead and challenge it. And it's made its way all the way up to the Supreme Court. So what can happen next? We suspect that oral arguments will be heard sometime in the next couple of months, and then a decision will be rendered before the end of the term, which is coming up this summer. Now, what could they do? In very loose terms, they could A, opt to uphold Quill, meaning say that it should still be the law of the land, or they could overturn Quill and in some way allow states to enact rules that speak to economic nexus rather than physical presence nexus. And really, I don't know, my colleagues at Grant Thornton, what do you think? What are your thoughts of what might happen next and what it could mean for businesses?
A lot. What I think is interesting about the original case is that there were three parties to it, one of which kind of withdrew almost, I don't want to say immediately, but pretty early on and just decided to comply. So it's interesting to see that what it was doing, to out-of-state sellers that, either took this up as a case or complied. And that was just an interesting kind of tidbit that we saw. But I think based on the states that we've covered to date in this presentation, we're seeing states really grabbing, Nexus by the reins and doing what they want with it. And, with this evolving e-commerce world that we live in and all of that, you can argue that things have changed. At the end of the day, what truly is doing business and what is the essence of doing business is, I think, the same. But the venues allowed to conduct business have changed. So it's going to be really interesting. I don't know if we're going to see things as specific as we've seen in, Massachusetts and Ohio in terms of verbiage and Mississippi and all that. But I definitely think there's going to be some really interesting stuff coming out and a lot of differing things. So that is going to be what's going to be interesting, how states define, nexus through all of this.
Well, what I personally think is interesting is that, will Congress, for example, be able to act subsequent to a ruling that overturns Quill, and then define what could constitute nexus? So, like embedded in those earlier bills that we were talking about, were requirements that in order for states to tax e-commerce, they would have to enact certain minimum simplifications. In other words, make sure that their taxes is easy enough to comply with so it isn't a burden. Like in this world where the court overturns Quill, will there still be room for this minimum simplification requirement? I find that kind of a really interesting open question of what role Congress will have to play after this goes down, if it goes down in a way that overturns the Quill decision.
Definitely.
It'll be really interesting. Sorry. I was going to say it's going to be really interesting to see what the rates will do, the locals will do, like local Colorado, local Louisianas and Alabamas. What kind of, are they going to are you still going to have to all register if Quill gets overturned in all those locations and all these different rates in some states that just have so many rates? It really will be a burden in those states, and will Congress do anything about it is a good question.
Yeah.
And
It's funny that
simplification as a whole, because, we've seen Alabama take things kind of in-house to try and simplify reporting. We've seen it happen in Arizona. Colorado has a task force that was put together for simplification, which I think is a little funny because simplification in Colorado is kind of a misnomer. But, they put together this task force that's put forth an RFI to the legislature to kind of see what we can do to simplify, remittance and compliance here in Colorado. So yeah, I think we're going to see some really interesting things come out of simplification, using that term.
Indeed. So let's turn for a few minutes on the developments in the area of soda tax, and really not only because it's interesting in and of itself, but it's very much emblematic of a trend we're seeing in terms of the continuing uses of taxation to influence behavior and concurrently drive revenue. So I'll turn it over to my colleagues to talk about soft drinks. Meanwhile, I'll have a soft drink.
Yeah, so we've seen some really interesting developments in this area, and I think it's worth discussion because it's just been very odd. We've seen these implementations of these taxes on, various venues that sell soda taxes. I think Kelly and I were discussing it last week with Chuck regarding how it's measured essentially with respect to, when you mix a soda with the soda water, the concentration, and how it's taxed on that ounce by ounce basis. And it's just a really interesting way to start taxing things that are what we call luxuries, right? Or sins. So we've seen things come through in Seattle. They passed this ordinance that began this year that imposes the tax on sweetened beverages. They're looking to hopefully get some revenue, and Seattle itself has said that they want to support public benefit programs. We'll see what happens with that. We've seen a really interesting evolution with respect to these taxes. I think looking back at where they first started, we saw them heavily in Philadelphia and Cook County, Illinois. Philly was a really controversial tax, which was interesting to hear and see. I think it went into effect, and then it was challenged, and then it was repealed, and it went back. And I don't think we really know what's happening in Philadelphia anymore with the beverage tax. And then, also looking towards places that really put it into place, like Cook County. Cook County, Illinois, fully implemented this tax. Everyone became compliant with it. They started remitting the tax, even though it was incredibly difficult to do. And then all of a sudden they repealed it back in December. So, now there's a whole process to get money back for those taxes remitted to Cook County. And then, we're seeing things grow across the, go ahead, Kelly.
Well, I think Cook County is, hopefully gives other locations kind of food for thought, because they tax based on ounces of beverage, which really was difficult for the vendors to get their system to set up like that. And also, I had heard stories of, you spend $1.50 on a 2-liter thing of Coke, but you're also spending almost that much on tax for that. So you've just doubled your cost because it's on ounces as opposed to actual dollar amounts. And it just was a little crazy. And hopefully other locations, if they decide to start these soda taxes, look at that and say, maybe we ought not do it that way.
And I think it's interesting too, we have a number of restaurant clients that really struggled with the fact of how do we do those like unlimited refills, things like that. So very, very interesting things out there.
One of the things that it really brings to the forefront is that states can do what they would choose to do to increase compliance, to generate additional revenue for their state. Understood, know why it's happening, know why it's required. But when they do it, it's important to sit in the shoes of the seller that has to comply, to make a solution that envisions a situation where these companies use automation to handle their billing, to handle their invoices, to handle their tax compliance, and frame solutions that are amenable to compliance regimes that are amenable to technology solutioning. I think that's really, really an important thing for states to keep in mind.
Absolutely. And we're seeing this too at the local level. I know here in Colorado, Boulder implemented a soda tax, which has been an evolution of a tax, to put it simply. But they've been working really closely with, the taxpayer, the public, just to make sure that they're doing something that can be complied with. They started being very broad with the imposition, where they taxed the active recovery gels you use when you run or do other sports activities. They've narrowed it down now to something a little bit more compliable, something that's less burdensome, I guess, in a sense. But we're seeing the same in a bunch of local jurisdictions in Northern California. I know that the Navajo Nation out of Arizona imposed a sugary beverage tax. So it's an interesting, very widespread tax that we're seeing. And it's interesting from, a social perspective too, because I guess we're looking at things and saying, hey, what does the general public buy a lot of? And so it is one of those things. So very, very interesting evolution of this tax, and it'll be interesting to see where it goes.
Indeed, agreed. So let's take a few minutes and let's talk about what might be happening in 2018. Of course, the whole landscape could change depending on what happens in the Supreme Court this summer, but there's a couple of things that may happen, I think, nonetheless.
Completely agree. I think, we've always said this, that if there were to be big tax reform, we're probably going to see things change at the state level, obviously. With now tax legislation in place, it may be a couple of years, but I definitely think we're probably going to see states take on gross receipts taxes and other taxes that, help to bolster state revenue. We're seeing things like that in Nevada with the commerce tax. We've seen the success that Ohio has the cap tax. So I definitely foresee states going along this route now that tax legislation is in place. I don't know if you have any thoughts on that, Chuck, or not, but I mean, I think it's just a natural progression, to be honest, personally.
Well, no, I would tend to agree. It seems like the next most likely avenue.
Right, and I think hand in hand with that is an expansion of the sales tax base. Because states are going to have a little bit more authority, likely if they decouple or do whatever naturally comes with respect to this new tax legislation, we're probably going to see a lot more, legislation being enacted with respect to, taxation of services or other areas of tax or of other areas of business that sales tax traditionally wasn't necessarily implemented on or imposed on. So this will be really interesting to see. We saw something similar back in 2016 with Missouri. So who knows? It'll be interesting.
Well, on this avenue, what do you think? So when I just before I started in the world of sales tax back in 2002, in and around that time, Massachusetts tried to enact rules that would tax all services, and more recently they tried to pass a rule that taxed technology-related services. Both were unsuccessful. Do you think we'll see targeted efforts to tax certain services, or more wide-ranging efforts to tax wide swaths of types of services?
I think it might be kind of a spread of it all. I foresee that states will go after software as a service, since a lot of states have already started doing that. And even though it's not a true service, and in essence that we think of a service, 16 states impose a sales tax on software as a service. So I think we'll definitely see wider reach on that. In terms of your more traditional services, though, I think it's going to be really hard for states to do that. We've as a tax-paying public, traditionally seen that taxes due on tangible personal property, right? things that we hold, see, feel, whatever. And obviously that definition is changing, but I think it's going to be really hard to define what a taxable service is. So I don't know. I really don't know.
And I think, states like Texas, for instance, the state tries to put everything under data processing service if they can fit it in there, except now they're saying, well, the software service is not data processing service because data processing only gets taxed on 80% of the value as opposed to the whole. So they want the whole of value for software services, but so they already have laws out there. And what else can we shove into this current law to make it taxable too?
Right. So let's talk a little bit about marketplace providers. In other words, it could be this time next year, we're talking about marketplace providers as really being a thing. And I think actually it could be a bigger thing in a world where Quill doesn't exist anymore. What role marketplace providers will have in enabling small seller compliance?
I completely agree with that. And, I think there's definitely going to have to be dollar thresholds. But at the end of the day, what is a truly successful smaller business these days? I think that taking a look at that makes us realize that $100,000 threshold for what have you is really not that much these days. So, whether or not a marketplace provider, exacerbates that or not is going to be something we need to really watch closely, because a lot of business is now done through these marketplace providers, whether it's your larger eBay, Amazon, or a smaller Etsy or one of those smaller ones that have created local following. Will we see things started on like a Craigslist, which is different obviously because you go directly through a seller, but who knows? It's going to be really a diverse landscape that they're seeing success in with respect to how legislation has been written in Minnesota and Rhode Island and Pennsylvania, Washington, etc.
And you also think there might be some developments on voluntary disclosures, much like the attempted but not enormously successful multi-state tax commission voluntary disclosure program.
Yeah, and we discussed this, between the three of us last week, that, it's interesting to see how the MTC, I don't want to say they failed, but they didn't have great success with respect to their amnesty program that they put in place. And I think that was because it was really, really narrow in terms of who could benefit from it. It had to do with, warehouses holding inventory in states. And then, if you go through an amnesty program with the MTC, you got to do it with every member state. So a lot of taxpayers didn't want to have to go through all of that. But if, remote seller, rules go into place widely through these marketplace providers or just in general, there's got to be some kind of amnesty or voluntary disclosure process to help shield the exposure that's going to be created with trying to get compliant with it. So I think we're definitely going to see several states roll out these voluntary disclosure initiatives or amnesty programs.
Maybe there's a lesson learned, for example, from the Streamlined Sales Tax Initiative, when states became members of Streamline. One of the requirements was that they offer a relatively broad-based amnesty, a very, very generous amnesty, for X amount of time after their membership became official, so as to encourage compliance. Maybe there's a lesson learned there in terms of states enacting economic nexus rules and then offering this amnesty, a period of time that allows sellers to become compliant.
Right. Definitely.
So this slide, of course, is my favorite. So let's talk a little bit about potential new sin taxes, including the potential meat tax.
I know, it hits me hard. I like my good cut of steak, right? So I think this is definitely an evolving area, right? We're seeing with the sugary beverages, we're seeing the marijuana taxes, definitely here in Colorado, California, Washington. And as that grows across the country, we've always seen it on tobacco, liquor and gambling. People put up with it. It's kind of what we were just used to. But there's been this big push to impose a tax on the consumption of meat, and a lot of that goes to the greenhouse gas initiatives and kind of, I think, looking at the landscape. Livestock, I think, counts for something like 15% of human-related greenhouse gases. And then they talk about how much water and all of that is used to, feed the animals and get them ripe for slaughter, if you want to go into all of that. But, if you take a step back and look at kind of where all this is coming from, it makes sense a little bit, but it's still, a tough pill to swallow, I think. So are we going to start seeing a lot of these taxes come into place? I would not, doubt it one bit. We've seen it, like I said, through the sugary beverage, and it's been successful. The marijuana taxes have been hugely successful. I know I can speak personally here in Colorado. We've had massive state revenues, and it's going all back to, to help with, education and rehabilitation and all of these things. So will these things go into place? I wouldn't doubt it. Are they going to have massive impact across the nation? I don't know. I can only speak what I've seen personally. But if these things have the impact that Colorado's seen just from the marijuana taxes, I think this could be a huge factor for state governments to impose these types of taxes.
Oh, I think you're exactly right. That the head spins at how they might impose a meat tax. In other words, thinking about things, will it vary based on the type of meat product and its negative impact on the environment? So maybe chickens are taxed less than cows, that are taxed less than fish. I don't know. And then once again, do we get into this per ounce scenario? Is it a fee per ounce? And what will that mean in terms of being able to comply? I imagine it's going to be ridiculously challenging. Will it be a retail tax like the Cook County sweetened beverage tax was, or will it be a wholesale tax? There's a lot of things.
Exactly. That's my big question. Completely agree.
Okay, so that's the end of our presentation. Thank you both, Metisse and Kelly, for participating. We have a couple of questions, and I think if it's okay with you, we can go over by a few seconds and answer one or two of those questions. Is that all right with both of you?
Sure.
Sure. Okay, so let's just grab a couple of these. For anybody who can't stay on in the audience, thank you so much for attending. But if you've asked a question, we might get to it right now. So we had a lot of questions come in about the Colorado notice requirement. And maybe that's because they've received some of these notices recently from their vendors. But one of them we got wanted to know whether the notice requirement applied to retailers, or does it only retailers, or does it apply to manufacturers? Would one of you want to take that one?
Sure.
I think it applies to everyone, doesn't it?
Yeah, so it's pretty widespread. Anyone who makes a sale into the state of Colorado that doesn't have, a physical presence here or nexus here, I believe has to comply with it. There is a de minimis rule, and I think it's $100,000. But yeah, it definitely is pretty widespread.
Does it matter whether the types of sales that they make are of the type that would normally be exempt under Colorado law? For example, let's say manufacturers, so people are selling to manufacturers, or they're selling wholesale from manufacturers to their clients. Does it matter that those types of transactions are otherwise non-taxable?
There is a provision within the rule that says that if the purchase is subject to tax or exempt, I believe you still have to provide the notice. So yeah. I think you still have to do it.
I think you're right. I think you're exactly right. The other question that came in was about the home rule locations. So how far does this notice requirement extend? Does it relate to state collected city and county taxes? Or does it extend only further to the home rule jurisdictions?
Yeah, so I was talking to you, Chuck, and Kelly about this morning. I sit on a group of home rule jurisdiction auditors, a coalition with them, and I was just with them last Friday, and they were discussing this issue pretty hotly, saying that they're definitely taking a look at this and seeing what they can do on the local level. But as of right now, this is simply a state level tax or compliance requirement, I should say. So it's only due for the state. I will say, however, there are some information sharing agreements between the state and the home rule jurisdictions. As a practitioner, I have no access to that. I don't think any of us do. But I wouldn't be surprised if we start seeing home rule jurisdictions imposing similar requirements in the next year or so.
Agreed. And one last question, again, about Colorado, obviously the hot topic. It's related to Colorado. And I know we talked about it in an earlier slide, but what were the other states that enacted those similar notice provisions?
So I believe Washington has a provision and Rhode Island has a provision. Vermont has one. Kelly, am I leaving any out that are current active? I believe there's a couple more, but I know that they're pending litigation. Yeah, I think they're pending litigation, some of the others. But right now, I definitely know.
Yeah, and it'll depend, I think, on what happens with Quill because, I can see more states, if Quill doesn't get overturned, I can see more states going to this,
absolutely
requirement.
Yep.
All right. So thank you so much. Kelly Metisse, I really, really appreciate you, your participation in this session. To those who are still hanging out on the line, thank you so much for attending. Stay tuned for further webinar activity from both of our organizations. Thank you so much. Have a great day. Have a great rest of the week.
Thanks, Chuck. Thanks, everyone.
Thanks.
Bye.